Most people expect retirement problems to come from things they can actually see: a market decline, a bad investment, unexpected expenses. But some of the most expensive retirement mistakes happen quietly in the background while everything else appears to be going fine. I'm talking about taxes. Not because retirees are doing anything wrong, but because retirement tax planning has become far more interconnected than most people ever realize. Roth conversions affect Medicare, Medicare affect the overall healthcare costs, your withdrawals to pay affect Social Security taxation potentially, and one decision can easily create unintended consequences somewhere else in the overall plan. So, this video, I want to walk you through 5 retirement tax mistakes I see people make all the time, even when their investments are performing perfectly well, because sometimes improving retirement outcomes has less to do with earning a higher return and more to do with keeping more of what you've actually already earned. Hi, I'm Chris Knight with Cornerstone Wealth Planning, and one of the biggest things we help clients navigate is how taxes fit into the broader retirement picture alongside everything such as Social Security claiming, investment withdrawals, Medicare planning, retirement income, and long-term financial flexibility. And if at any point during this video you'd like help evaluating your own retirement strategy, then I've included a link in the description where you can schedule a complimentary call with our team. Okay, let's begin. Mistake number 1: doing Roth conversions without understanding the ripple effects. Now, this is one of the biggest misconceptions in retirement planning that I hear right now. People say taxes are going to always go up, and they think I should convert everything to Roth right now. Sounds simple, right? Well, not necessarily. And this is because Roth conversions done in isolation are not always done properly. And this is where many retirees accidentally create a chain reaction that they never saw coming. So let's go through an example. Let's say a couple retires at age 63. They have $1.5 million in IRAs, their Social Security is going to begin soon, and they have moderate spending needs. So in this first year, they decide to go ahead and convert $200,000 in a single year because they believe that down the road, these taxes will be higher. So on the surface, that all sounds reasonable. Now, here's what could happen though. More of their Social Security in that year becomes taxable. Their Medicare premiums may be impacted by IRMA costs, which are increases in surcharges for Medicare, and they may move into overall higher tax brackets. They could also lose out on favorable capital gains treatment on some of their other assets. They may pay substantially more taxes upfront than what would have been necessary. Now, this is why retirement tax planning isn't just about eliminating taxes. It's about improving tax efficiency over your lifetime. So sometimes Roth conversions can make tremendous sense. Now, other times they may become a very expensive overreaction. Now, the key really is understanding how the conversion affects everything else. Because taxes affect those withdrawals, withdrawals affect Social Security impacts Medicare, and Medicare affects your long-term cash flow. Everything connects together. Brings us to mistake number 2, triggering Medicare IRMA surcharges without realizing it. Now, this one catches retirees off guard all the time, especially very high savers, because many people assume Medicare costs are very straightforward once they reach age 65. Then suddenly their premiums will jump. Now, the reason is something called IRMA, IRMAA, which is Income Related Monthly Adjustment Amount. In very simple terms, if your income exceeds certain thresholds, Medicare premiums increase. And sometimes this can be quite significantly. What surprises many retirees is that this IRMA, this charge here for your income and the Medicare cost, is based on the income from 2 tax years previous. So it's not just looking at what's happening this year, but it's actually looking at what's happening now, how it's going to impact things in the future, and then also if you're looking back to see how your Medicare costs may be impacted later based on what's going on. So let's just imagine for a second, You sell some appreciated investments with capital gains. You complete this very large Roth conversion. You take a sizable IRA withdrawal. You also maybe sell a property. This will spike your income for this 1 year. Therefore, now your Medicare premiums increase as well. Now, for some retirees, that can mean paying thousands more than they ever expected for Medicare costs. And the frustrating part is that many people didn't even know that these thresholds existed until it was too late. And this is why retirement planning becomes much more nuanced than simply asking, how much income did I generate? The better question becomes, how efficiently did I generate the income that was needed? Because once retirement begins and taxes, Medicare withdrawals, and income planning start interacting with each other very quickly, and so if you're approaching retirement and trying to figure out these questions, such as how much should come out of these IRAs? When do Roth conversions make sense? How can Medicare costs be better managed overall? Or how do these taxes fit into the broader retirement income strategy for the total plan? That's exactly what we help clients with evaluate every single day at Cornerstone Wealth Planning. And the link in the description allows you to schedule a complimentary retirement strategy call with our team where we'll help you identify potential planning opportunities and to see whether your retirement strategy is working together efficiently over time. Now let's move into another mistake that frustrates retirees more than almost any other. So mistake number 3, paying more tax on Social Security than is necessary. Many people spent decades believing Social Security was always tax-free. Then retirement arrives, and suddenly they realize that up to 85% of their benefit could become taxable. Now, what makes this even more frustrating is that retirees sometimes create the problem themselves through poor withdrawal income coordination. For example, let's say someone needs $40,000 of income for the year as far as cash flow, and so they begin to withdraw this automatically from their IRA accounts. Well, all that is taxable in this year that is taken out, which can cause higher Social Security benefit amounts to be taxable, which then creates even more taxable income overall. And this is what many advisors refer to as really a tax torpedo that begins after Social Security. And this effective tax rate could become much higher than people ever expected. Now, the good news is there are often ways to reduce the impact here. Sometimes this could mean using Roth assets strategically, drawing from non-qualified or taxable brokerage investment accounts, and managing gains more carefully overall, or simply coordinating those withdrawals before Social Security begins. And this is where people often discover that retirement planning isn't really as much of an investment issue any longer. It's more about coordination. Because once retirement begins, taxes, withdrawals, Social Security, Medicare, and income planning, they all start to affect one another. Really small decisions can have much larger consequences than people would ever expect. Now let's move into one of the most overlooked tax opportunities available to retirees. So mistake number 4, missing the low tax or no tax capital gain opportunities. Now this is one that surprises a lot of people, especially retirees who assume they should never realize gains because they'll automatically owe capital gains taxes. But in some years, retirees may be able to realize gains at very favorable tax rates, potentially even 0%. And many people miss this opportunity very completely, entirely because of missing the point here to plan for this. Because retirement often creates these temporary, low-income years. Let's think about it. If you especially could be true before Social Security starts, before your required minimum distributions begin in your mid-70s, for most folks around age 73 or 75, or immediately after you leave your working years, because those years can create valuable planning opportunities. Now, unfortunately, many retirees simply don't know this exists as a strategy. So they continue to defer those gains and do that automatically. And then later, RMDs begin, Social Security has begun, the taxable income increases, Medicare costs rise, and now those same gains become extremely more expensive. This is why proactive tax planning matters so much. Not just preparing tax returns after decisions were made last year, but evaluating the opportunities before the time to do these will disappear. And that is a completely different mindset overall. And it's one reason many retirees appreciate having a coordinated planning process in place because the decisions become interconnected very quickly. And finally, let's talk about the biggest mistake of all. So, mistake number 5, thinking that investment performance alone determines retirement success. Many people assume retirement success comes down to one thing, just the investment returns. But two retirees can earn the same exact return and still have and experience completely different retirement outcomes. Why would that be true? Well, it's because taxes, withdrawal strategy, Social Security timing, healthcare costs, your overall investor behavior, and then overall optimal coordination. That is really the difference. And I've seen retirees with modest returns thrive financially because their overall plan was integrated and connected and coordinated very well. And I've seen retirees with strong, big portfolios create unnecessary stress because key decisions were not connected together. And this is why we spend so much time helping our clients just simply connect the dots. Because investments certainly still matter, but retirement planning also requires all of the overall coordination between all these various areas of your overall financial plan. So the goal isn't simply building more wealth, it's turning wealth into sustainable income and long-term flexibility to meet your specific retirement goals. And for many retirees, that becomes increasingly valuable over time. Because eventually, most people don't want to spend retirement monitoring the tax laws, the new Medicare rules, monitoring all the market conditions, and withdrawing from certain strategies this day, that day, and every week into the future. They want clarity, simplicity, and confidence in their plan going forward. They want to spend more time enjoying retirement and less time worrying about it. So if there's one takeaway from this video, it's that retirement tax planning is rarely about finding that one perfect strategy. It's really usually about understanding how each decision affects the other and how they're all connected together. And these tax decisions made today can continue impacting retirement many years, many decades down the road. The retirees who tend to keep more of what they've earned are usually not the ones chasing complicated strategies. They're the ones making sure that the major financial decisions are all working together cohesively, and that's really real retirement planning overall. So if you'd like help building a personalized retirement strategy around taxes, withdrawals, Social Security investments, and long-term retirement income, real simple, please click the link in the description where you can schedule a complimentary call with our team. Because retirement isn't just about growing your money anymore. It's also about keeping more of it. And often the difference between a stressful retirement and a more confident one has less to do with investment performance and everything to do with connecting all the dots. So thanks for watching, and I'll see you in the next video.